Today I'm going to go over the top 3 real ways to get 100% financing in real estate. When I talk about 100%, I'm really thinking 120 because besides purchase, rehab, you still have those closing costs, you still have those carry costs, which are payments, any overruns, and even pre-funding escrows, just to name a few. So number one, what's the number one way people in this market and over the last 20 years are funding those down payments and getting to 100%? HELOCs. It doesn't matter if it's on your primary residence or as some investors, HELOCs on every rental property they have because available money at your at your fingertips helps in any situation. Doesn't matter if it's a fix and flip or a burr. And of course, today we're not talking about cash because if it's cash, you understand it. We're talking about the 3 ways to get to 100% by refinancing. Once again, HELOC's number one because of the easy access. Every time you need the money, you just go over and transfer the funds into your checking account. There's no hassle. There's no going through some paperwork and actually getting someone's permission to either buy this deal by putting the money down or, if your budget runs over, there's no asking anybody if they can increase the money from, the fix and flip loan. Remember going back, the fix and flip loans or even a burr loan, typically they're going to fund somewhere between 80 and 90% of the purchase and up to 100% of the rehab. And that's where your money comes in. You have to put in that 10 to 20% of the down payment and any escrows that they don't cover, plus any overages. We know there's always overages or most properties, there's some overages that come up. And there's also, you have to get your contractors their money when they want their money. And the only way to do that is have it available, not waiting for the escrow to open up from your lender, because if they're waiting for inspections or anything, HELOC is the number one just because of the ease, just because of the cost. Interest rates are going to be lower than what you're paying for your hard money or fix and flip loans. And there's no points. There's no closing costs besides the first time you get it. But remember the HELOC, once you set it up, most of them are open for business as long as you're complying by all the rules for 10 years. So you could use that on, 2 properties a year. That's 20 different properties over the life of that one HELOC. And as most real estate investors grow and they get rental properties, they're putting HELOCs on everything. And sooner or later, they become their own self-funding machine. Even if that just means putting more money down on the fix and flip because it is cheaper money. It is easier money and it is fast, flexible, and at your fingertips. For instance, we have a lady who's closing tomorrow on a property and she needs about $85,000 for closing costs, carry costs, everything that she wants to put in above and beyond that typical 75% ARV. And she's using part HELOC, part cash. So she has about $55,000 in a HELOC. That is part of her, if you want to call it gap funding, whatever you want to call it, her money to get to the 100% financing, really the 120%, is partially using her HELOC. Opens up doors for different projects, opens up and keeps a project going fast. Real estate investing is about getting a property, getting a good property, getting it done and back on the market or refinance as soon as possible. Having your own funds, like a HELOC, helps that process. Not only when you're looking at properties, when you're looking to purchase them, you get in and get done fast, you're not scrambling for money, asking for permission from, your lenders. And if you have the overruns, it happens, or just you want to change something up, typically lenders aren't going to change their escrow midstream without some kind of complications, some kind of time frame, something that's going to slow you down even more. So by having something flexible like a HELOC, it makes it so much easier. And most top investors have this in all 3 that we're going to go through today. And for those who don't know what the true costs or what the estimate of the true costs are going to be, besides the purchase and the rehab, we have a free calculator, just runs through high level what anticipated, expenses are going to be from carry costs, depending on how long you have the property, to, be putting in some information there for overruns, stuff like that. So you have a good bucket of money stack there for whatever comes up, because speed is king in real estate investing. So check that link below. Number 2 is business lines of credit. Somewhat similar to a HELOC, but a HELOC, of course, you need a house. You need equity in a house. You need the You need to be able to or want to use that house. Business lines of credit are something completely different. And most of the big investors or good investors have business lines of credit. They typically are, anywhere between $10 and $100,000. Even us as a business, as a lender, we have two unsecured business lines. One for about, nothing huge, like 25,000. The other one for between 55 and $60,000 with two different banks. Good point on where do you find most of these, like HELOCs. I always shop at local credit unions and or um, mid-size regional banks. Now, for lines of credit, for business lines of credit, who's best in that? It's the larger banks like US Bank, PNC, Chase, even American Express. If you get the card, they will offer you a business line of credit. And it's very similar to, like a hybrid between an home equity loan, credit cards. They all kind of work the same. You have a credit limit, a bucket of money that you could use, pay it back, use it again. They're unsecured, so that's what's nice. Once you get established, it is a great tool. It's going to be a little bit higher interest rate than a HELOC. It just depends on your credit. It could be somewhere between 10% and 18%. But remember, on a business line of credit, most business lines of credit, they're not going to charge you to access it like a credit card where you get a cash out. Like where you pay the 5% on a credit card to get a cash out. Business lines of credit are very similar to how a HELOC works. You could go, they may have you deposit a check off your business line, or you may have the business line with US Bank in your checking account there, and you could just transfer it over. Once again, easy access. Once it's set up, you're not going to ask to have, you don't have to ask them for permission, what you use it for. Whatever you need it for, down payment, monthly payments, paying your contractor, just paying yourself until the property sells, you could use this business line of credit. Great tool, and it does not tie up one of your properties. And another little trick is if you get a Chase card or an American Express card and you use it for a few months, they offer these kind of, loans. Some of them they might try it out like a fixed rate for 3 years, maybe something like that, where it's a fixed payment, fixed amount, but it's a stepping stone. A lot of these things, sometimes you have to build to get there. When we get to number 3, that is something completely different. Can happen day one and something you build over time. But most of these require good credit, some kind of income that they can verify. The better the credit, the more income they can verify, the larger you're going to get. There's been a time where we help people set up business lines of credit. And typically the thing was good credit. And if you had enough money in retirement, stocks, bonds, whatever that may be, they would take a third of that up to $100,000 and pretty much give you a business line of credit. It wasn't even that bad a rate. But just remember, HELOCs, business lines of credit, you're not paying points, closing costs, or sharing any of the profit when you use those sorts of funds. Number 3 is something that we have used since 2008, and that's private loans. That's people's private money. Or even, sometimes even a partnership. Could start as a partnership and then becomes loans. I love private money because it gets rid of all of the banking issues that come up. We see it right now. People's credit sometimes maxes out, which drives down their credit score. When they drive down their credit score, what happens to these business lines and credit cards that you have out there? The banks start lowering your available credit and makes it even harder for you. You get into private lending, private money, real private money. What I'm talking about are people out there, not even family or friends, but people out there who are looking for a better return, a secured return, a safe return. They may be getting 2, 3, or 4% from a bank, and you could give them 8, 9, even 10% and still save a lot of money. As you go through real estate investing, you need to start building these relationships with ordinary people at, real estate clubs. I remember one of the first big events I went to out in, Oakland, California, the Bay Area, room packed, and this guy was talking about how a real estate groups are really set up. He goes, half the people here are looking to do deals, and the other half of people have some kind of money, but they don't want anything to do with the actual day-to-day operations. They're just looking for a better return than the banks or the bonds or whatever can give them. So right now, if you're looking for, and you should be building and trying to find real private money, That means people have money in their IRAs, people have money in CDs, whatever, that want to double or triple their return and still give you a cheaper cost of money. This is where you go. This is what you look for. So many, especially as people start growing and really getting escalated in real estate investing, focus on real private money. No credit checks, no applications. Once you've built these establishments, once you've built it so that you have a relationship with people and you prove that you are someone who's honest and working to get their money, get their return, this just keeps improving, improving, improving. We've done thousands, tens of thousands of loans with real private money. And it just keeps growing because we treat those people good. But it's great because in 2008, we were a lending company that relied on banks. 2008, their crash hit. Guess what happened? Within 3 months, every line was called, every credit source was called, and we're kind of left high and dry. That's what you don't want to always rely on. What's happening in the banking, what's happening in the, what's the Fed going to do? Doesn't really matter to private people. So remember, private money, typically once you get it going, hey, I got a deal, let's get it funded. Hey, I need money for a down payment, or I need money for the whole thing, or I need a longer term loan just for a rental. Real private money. If you have any questions on that, we've done it. We know it. Reach out to us. We'll put a link below too. But this is all about the big three, about how do you fund 100% finance besides what the lender is going to do, that 80 or 90% purchase, 100% of the rehab. You're going to look at HELOCs, not only your primary, but on every rental you have. The bigger the pool of HELOCs, the more control you have over the money and the deals that you can look at. Because remember, HELOCs, business lines of credit, even real private money, you're not paying interest if the money is not used. So it's a great stored source of capital. So these are the three most common sources that we see people and how they're funding the other part and getting to the 120, 100%. And it takes some time. It takes some diligence. But, in 2-3 months, you can have most of these set up and working for you. So start now, get your credit in line. Make sure your credit score is, the higher the credit score, the easier it is to get number one and number two. Get those relationships started. Get into the meetups. Start talking to people with private money. Start showing people that you know and work with of what you're doing, because there's always someone who has 10,000, 20,000 that they're looking for a better return. And then you're going to find people with 100 to millions of dollars that are just looking for a secured return. So start taking this serious today. Get these three. It may take you, like I said, a couple months, but get them set up and keep them growing. The biggest thing you can do is increase the funding stack that you control the money. Not that you have to ask a Kiavi or us or whoever, is this loan approved? Is this deal approved? Can I get more money? Can I skip a payment? Any of those things you control when you control the money at your fingertips. Remember, the successful investors plan before they buy and before they get into it. Stay connected, stay funding. Check us out in our next video.